Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey everybody.
Hey Lauren, we've been talking about this upcoming fiscal cliff that the media has been talking about with the potential tax increases and also the automatic budget deficit cuts that they're going to do. I've been getting some feedback from clients, and I'm seeing a lot of strategic planners out there talking about, you need to do this before year end because of this potential tax increase. You need to do that. There's some obvious things, like for a business, if you really felt were concerned about the rates going up, let's say 4 or 5% next year, perhaps a business would want to defer some deductions into next year if they could take them next year versus this year. Perhaps if they had the opportunity to delay billing for their services in the month of December, they can do that into January. But the one that is causing me bigger concern is the investors, where they are feeling, they're getting some calls from the brokers saying you should sell your capital gain assets all this year because you're going to pay 15% capital gains tax, because next year it might be 20%.
Right.
What's your thoughts on that?
That's a great strategy if it's something that you should have been doing for a long time now, and you've just been putting it off. Then here's a great reason to do it. It's a terrible strategy if you're using it as an excuse to sell out of the stock market because you're just worried about something.
Right.
And I was just talking about this with somebody else, and they were saying, well, I realized that in a bear market, the stocks could go down by 50%, and I'm just not ready for that, so I think I'm going to sell out of the markets. And I just think, look, this is why you set up a portfolio with a mixture of stocks and bonds, so that whatever mixture you pick isn't going to go down by 50% just because the stock market goes down by 50%.
The other thought there is, let's say you do have investments that do have built-in gains, and and you're doing it just to say that I want to get this 15% tax rate versus 20. Well, the thing that people forget is, let's say you sell that stock, technically you're supposed to wait 31 days before you buy that stock again. So there's potential lost opportunity cost for being out of the market for 31 days. The second thing, though, is that you've permanently forever lost that 15% taxes that you're paying to the government versus deferring it into the future. And then there's the lost investment opportunity on the tax money you just paid out of your funds.
Oh, right. Yeah, that's
so. What I figured out. Let's say if the average stock return rate is about 10% per year, and that might be a little high in these current conditions, so let's say that's what it is, and you pay 15% now versus waiting 20 years to pay that 15% for a long-term portfolio. All these years you've lost that investment return on that 15% that you paid. So I think that's another bad reason. But I agree with you. That's an absolute tax policy is an absolute terrible reason to sell out of your investments early as part of your long-term portfolio planning. Well, thank you for watching this episode of Erickson TV, and we'll see you next time. Bye now.
See you next time.